Yo, what's up guys? It's Kojo Forex, aka GBP Legend, aka Sniper Trader, aka King of Blues. I'm here again, and today I want to teach you guys about how to master entries on the Forex market, which I call the Sniper entry. Yeah, so you guys, as you are aware, I gained the name Sniper Trader from the way I take my entries on the Forex market, right? So sometimes a lot of people see my strategy in my entry and then they say, Kojo, why do you catch market at tops and bottoms? That is not really a cool thing, right? But that's actually because they do not understand the preamble in which I base on my entry and then my analysis on the market. Catching market at tops and bottoms could be from any time frame at all. You could catch market at tops and bottom on the 1 minute time frame, on the 5 minute, on the 15 minute, even on the 30-minute time frame, right? But catching market at the beginning of a new trend means that you're really looking at the bigger picture of the overall directional movement of the market and then joining in earlier before that new wave of movement. Okay, let me put it in the scope. You cannot call movement on the lower time frame a directional movement or a trend in the market. And lower time frame, I mean the 1 minute time frame, the 5 minute, 15, all the way even to the 30-minute or 1 hour time frame. These kind of movements, you cannot call them a trend in the market, right? So for you to really get the trend in the market, then you should be looking at the bigger picture, the weekly, the daily, the 4-hour time frame. Minimum I would look at to determine a trend in the market is the 4-hour time frame, right? So that's how come I'm able to catch the market at the beginning of a trend or at the inception of a new trend, and not necessarily catching market at the very top or at the very bottom, because catching market at the very top and the very bottom on the lower time frame, which is the 1 minute, the 5 minute, the 15 minute, doesn't necessarily qualify to be the beginning of a new trend. So guys, in my previous video, which is my first YouTube video, I explained to you guys that when I started trading, I tried out so many systems in the market, including indicators, right? So upon using several indicators, I realized that most actually worked and most actually didn't work in the long term, right? But even the ones that worked, after backtesting for a while, I realized that they did not give me the kind of refined entry that minimized risk on the market, right? I'm going to pretty much go into the chart to show you guys exactly what I mean, but I'm trying to make you guys understand the whole concept of why I catch market at the very top or at the very bottom, so that you understand into details how it manages risk on the market, right? So like I told you guys from previous experiences, I used to use moving averages, and I used to even use the RSI, which is the overbought oversold condition. I used to use the Bollinger Bands. I used to use the Bill Williams alligator. I used to use several indicators on the market. I tested them out individually because I told you that I wanted to understand the whole scope of the Forex market and every system that people have advertised to be the most effective that works for them. You understand me? So after putting on several indicators and then backtesting, let's say the most popular ones could be even the 200-day moving average, the 50-day moving average, and several other ones, right? Regardless of the time frame that I look at, these ones are moving average. The whole concept about it is that when the moving average crosses on the top, then you're looking for a short, and then when it crosses from the bottom, then you're looking for a buy, right? When it crosses from the top, trust me guys, then the trend must have already set in motion before the moving average is going to cross. And then when it's crossed from the bottom, the same vein, the trend had already set in motion, right? So catching the market when the moving averages cross means that you're not catching it exactly at the very top of the trend, and then or exactly at the very bottom of the trend, right? So you must understand that in trading, it's all about capital preservation and then managing risk, right? Remember these two things in trading. Number one is capital preservation, and then number two is managing risk on the market. So when it comes to managing risk, then it means that whatever system that you're using to trade, you shouldn't expose yourself to too much risk by putting your stop loss way above, like way higher than your entry level, right? Because it exposes your account to too much risk if the trade should turn sour, which it usually do happen in the market, right? Nobody is perfect in the market. So if you have a trading system that allows you to risk, let's say more than 50 pips, 60, 70, 80, 100 pips. Sometimes I see people putting stop loss as much as 200 pips in the market. It doesn't make sense at all. And then you're just most likely do not have much knowledge or information of what you are doing on the market, right? So this even builds up to the point of what we call risk to reward in the market, right? So guys, if you're talking about entry in the market, you're looking at where you want to jump in on the market and where you want to put your stop loss to determine how much potential move you are expecting to make on the market. And that is the definition of what we call by risk to reward. So if you're finding a system, or if you're using a trading system that allows you to risk, let's say 100 pips, and then the trade jumps into 40 or 50 pips, and then you're closing your trades, you're risking more than your reward. You get it? So it means that if this trade, if you should have even 2 or 3 trades go in your favor, and then you're making 30 pips, 40 pips, one single loss can easily wipe out your whole trades in the market, or your whole profit, right? So that's how come it becomes so much important and there's so much of a priority that every trader should want to analyze or should want to prioritize entry points in the market, right? So if you do not have a system that really gives you that clear-cut defined reason of entry and then where to place your stop loss, then you've not still got to that point yet where you have confidence in the market. Because like I said, with the scenario of the moving averages, right, there are several moving averages that will allow you to put your stop loss way above the market directional movement, right? So now I want to give you guys a little bit of just into my concept of how I can buy entries on the market, right? Just with theoretical aspect now before we jump in onto the technical aspect where I show you on my screen how I get my entry. So the whole idea of my sniper entry is that I am catching market at the very bottom of a trend, or at the very top of a beginning of a new trend. So what that means is that for the most part, my stop loss has to be at the top of the range, or at the very bottom of a new market range, right? So what that also means is that after I've got all my confirmations of an entry into a market for any directional movement, it could be a bullish move I'm expecting, it could be a bearish move I'm expecting. If the market should hit me out as stop loss, what that only means is that that is not the turning point of the market. That is obviously not the beginning of a new trend. And then I have to just stay out, wait, and then let the market do its own thing until it hits a next point where I have confidence with respect to my technical analysis that this could be the next potential turning point in the market. So it makes taking a loss on the market not really painful at all, because it makes you understand psychologically that you are trying to catch the market at the beginning of a trend, or at the bottom of a new trend, and hence you are liable to risk 40 pips, 30 pips, sometimes maximum 50 pips on the market. But if I am catching the wave of that new trend, you guys can clearly tell how the market trends move, mostly in the range of what, 100 pips, 200, 300, sometimes even 1,000 pip, right? There's been scenarios where I've caught even 2,000, 3,000 pip movement on the market just by risking 40 or 30 pips. And that is what I want to show you guys now about sniper entry strategy. So you know what? Stay with me for a while. Let's go into the chart and I'll show you guys my sniper entry strategy. Yeah, so guys, to explain what I've been sharing with you with respect to my entry criteria and then catching market at the very top or at the very bottom of the range, now I'm going to be using the pound versus the United States dollar to explain to you into details how I look at the market, at the same time introducing certain key concepts that I use as part of my confluence in taking trades on the market, right? So if you look at this, you can clearly realize that in my chart analysis, I only watch the higher time frames ranging from the 2-hour time frame, the 4-hour, the 6-hour, 8-hour, 12-hour, daily, weekly, and then monthly. I start with what we call the top-down analysis, looking at the market's overall directional movement and then putting my market into a specific range of pips for its monitoring, right? I'd want to go more into those details in subsequent videos, but now I just want you guys to get a clear perspective of how I spot tops and bottoms of the market, right? So I also include certain key concepts which ranges at the same time from the Fibonacci levels, and I also watch certain key principles like trend lines in the market. And then another key concept that I also apply in my confluence is candlestick reversal patterns, right? So when I put together all these key informations at the same time doing what we call cross-referencing and correlation, it allows me to be able to know at any point in time what currency pair is right to jump on, and then at what point I should jump on into the market with a very minimum risk in the market. So if you're looking at this, I'm currently on the 6-hour time frame, and I just want to show you guys clear concept of what I meant when I was talking about market overall directional movement, right? So if you look at this, you can clearly see that this was what this market's turning point all the way from this top, and then it traded massively onto the downside until hitting this point, and then there was what a continuous an abrupt reversal back into this range, a turning point here into this point, a turning point here into this point, and a turning point here into this point, and then the next turning point into this range, and then it continued all the way down and currently running up at this point. So in my strategy, how I look at the market is to be able to determine that at this point the market is going to reverse and make a downward trend. So I want to jump in here for a sell. And then here I also determine that this is the key point where a new beginning of a wave or swing point for a jump in for a buy. And then I want to jump in for a sell here for a next swing point, and I jump in for a buy here for a next swing point. It may look very difficult, and I mean it may look easy as I'm putting it out, but it isn't an easy concept, right? And then it also may look very difficult, but at the same time it isn't an elaborate or difficult concept if you come to understand the whole nature of how these analyses are properly done, right? So another concept that comes to play a very important role in my strategy has to do with what I call the top-down analysis. I talked about top-down analysis, but what I meant to say was the support and resistance levels, right? So which sometimes people call the supply and demand levels, right? But supply and demand doesn't necessarily form the overall core confluence or core decision into taking a trade in my strategy, right? So sometimes I see a lot of Instagram traders marking up their chart, trying to carve out support levels and then resistance level, and then determining those levels as supply and demand levels, right? So I hit my levels because I wanted you guys to understand the core concept of what people usually do before I bring up my explanation of how I look into the market. So you can clearly see that sometimes you have people mark up maybe this range as what support level, and then they extend the line all the way up, and then they could mark up this range as what resistance. I mean, here is going to be resistance, 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 and then they could mark up this range as what support level, support level, support level, resistance, because you are seeing the market resisted this range and then it moved down, resisted this range. Sometimes people would say the market broke out of resistance from here, and then it came all the way back up into the range and then continued all the way down to this next support level, because the market has been acting as a support here, and then they'll say this one was broken. So pretty much becomes sort of a basic way of analyzing the market when I used to first be trading in that support resistance or supply and demand kind of a scenario. So I wanted to do something different, explore really why this sort of movement or dip here occurred, or sort of a dip here will occur, or sort of this out of the range perspective will also occur. So that's how come I also decided to spend so much time in building my system to understand why these type of stuffs occur, right? So in my exploration into the market, I realized that there are certain times where the market will use some key psychological or institutional levels to also reverse. So I wondered, why would the market reverse at a key price point? Because you must understand that this is a speculative market of the international currencies. And this is not just a playground where we are just observing random market movement. The market, as my experience built up, realized that it's not just a random marketplace for movement. Prices stand at a place for a specific reasons. You must understand that there are big players in this industry who control price movements, right? And they know exactly where they want to fill their orders before a reversal. So in applying this key concept and confluence of the Fibonacci, the trend line analysis, the top-down level, the key psychological level, and reversal points in the market, it adds up and makes up an element of a strong confluence that when they come together, I'm able to find a refined entry that spots market tops and market bottoms on the market. Like I said, I'm not going to be disturbing you guys or bothering you so much with the core details of the top-down analysis, but when I plot out my levels and my key ranges, then you're going to get clearly what I mean by catching market at the very top or at the very bottom of the beginning of a trend, right? Yeah, so quickly when I unhide my levels, then you can now, as you guys may be seeing, my key levels in the market, right? So you can see that with this big dip here, which I was showing you guys a while back, the market decided to hold off on 1.150 as a key support level, right? And after all the rallying back into this range, it came a little bit close to this 1.1250 and then came back here to hold on 1.2250 as a support and then rally back. So all in between these ranges, the market keeps on respecting psychological levels in the market. It doesn't always use those levels to reverse, but that's why I add a concept of what the support, resistance, supply, demand, trend line, Fibonacci levels, all as confluence before I come up with a decision to buy or sell when all my criteria for a sell is met, right? So in trading, that's how come most people would advise you that you need to have a rule or a rule-based system, or you need to have a trading plan that cuts out or gives you clear indication of when you should enter the market and when you should stay away. So my trading plan necessarily spells out exactly where I should jump into the market and then what kind of trade I should also avoid. And I try to take trade on lower highs or higher lows at the same time, on key levels or key psychological levels, and at the same time on key retracement level on my Fibonacci level. So that spells out my key entry criteria on this market, right? So for a position like JBP USD, you would find that I would find an entry here, which would be my initial trade for a sell, putting my stop loss right above the wick here. That is because in this area, the market is acting on 1.2750 as a reversal zone for me, and I get the indication of the reversal when I clearly zoom in and then read into the candlestick formations, identifying some reversal patterns which include the doji, the shooting star, and stuff like that that I wouldn't want to mention out all here in one video, right? So right after there, you can see that there was a big drop off from this range all the way to this range, which makes about 250, 260 pips on a single position. If you're able to find your entry right off at the top here, put in your stop loss right above the range, which would have been about 40 pips and stop. And then at the end, you realize that it makes up for a good risk to reward ratio on the market, right? So for the purpose of this, I'm going to switch now into the 4-hour so that we understand again the next concept, which has to do with applying Fibonacci on the market. So a lot of time people do not understand the real meaning of Fibonacci and then how to even use the Fibonacci tool, right? So how to use it is that the whole concept of Fibonacci measures a retracement level in the market. So Fibonacci tells you that the market can make a move on a swing point from a lower high to a new higher low, or higher low to a new lower high. So one swing point to another, and obviously what you expect is what? A retracement. So let's say this one is swing point A to swing point B. Before the market will continue from swing point A to swing point B to the next point, it makes a retracement or a pullback, as you may call it, right? So it pulls back into a previous movement, the opposite direction of the previous movement, right? But in the course of that pullback, the Fibonacci tool measures the probable percentage of that pullback. So if here is A and B, we could label it again as 0, or let's say 100, and then here being 0, right? So if this is 100 and this is 0, it's safe to say that the midpoint would be 50, and then it's also safe to say that somewhere here could be 60, and then somewhere above here could be 70, right? So key concept of Fibonacci ratios that I use is the 50, 61.8, and 78.6. So if the market is pulling back up into this range, Fibonacci tries to measure where is the market possibly going to reverse. Is it going to reverse in the 50% and then continue its wave down? It's going to reverse into the 60% and then continue its wave down, or perhaps the 70% and continue its wave down. You understand me? So after I have been able to catch my swing point of an initial move, I may be able to jump in on a retracement if my market reversal spot on entry at another key or key psychological levels that makes up a better risk to reward to take the risk on. Other than that, I would avoid that position and then wait for a Fibonacci retracement. So with respect to this kind of a trade where I've just showed you that 250 pip drop, the next way to get an entry into this trade for the next wave of movement is when I measure my Fibonacci level from this top range all the way to this bottom range. So it becomes equal to understand that this is the swing point from swing point A to swing point B, and then we made, so the market moved from this range to this range, and then we made a retracement back into that 61.8 region where it would be a prime area for a sniper trader to get a shot into the market, expecting what a next wave of movement from this top to possibly hitting this Fibonacci extension level or even this one here, right? So that makes up for what the second criteria for entry in the trade. So the first criteria I showed you using that key psychological level to jump in on the trade, with using the candlestick formation as a confluence to jump into the trade. And then the next one I've showed you that you could use the Fibonacci as a next confluence or next point of call to jump in on a trade. You can clearly see that this market continued to make next wave of movement, and then there was another wave of movement here, right? So to catch even this third wave of movement, so you can see that this is the first wave of movement, the second wave of movement, and then this one becomes the third wave of movement. To catch this third wave of movement, we could apply other concepts at the same time. Two concepts here. We could use the Fibonacci again, and then we could use the trend line basis again. So if we're using the Fibonacci, obviously, like I explained earlier, this will now become the new wave of movement of the swing point A, and then this becomes the swing point B, and then this is the retracement of the new wave of movement. So here again, we can plot our Fibonacci starting from the very top to the very bottom to measure that retracement level, and then you can clearly see that in this kind of a scenario, the market reversed into the 50% and then a little bit into the 61.8 before reversing or before continuing and trend all the way down, right? But again, to get a strong confirmation for that entry, which have been a perfect sniper entry from the very top of this range to cut the market to continue all the way down, then it has to do with applying another concept which I mentioned, which has to do with the trend line. So a lot of time I see a lot of people confusing trend lines, drawing the lines to cut in between the trends, and then some people will draw something like this and then say this is their trend line and stuff like that. Well, the way I draw my trend line is from points to points, right? And then, like it's clearly said, for you to draw a line, it's 2 points. So my points here in the market becomes the wick ends on the candlestick formation. So in such a movement like this, I'll start my trend line from the very top and then connect this one through to the very second wick of the next wave of movement. So here becomes my first point, and then here becomes my second point, cutting through the third one here, right? There is an entry criteria on my trend line, which I would determine around the third touch of the trend line to determine whether it holds off strongly to continue in that trend direction, continuous movement, or it's going to break that trend line and then continue moving up. And this kind of scenario, I really teach it in my advanced course. But here you can clearly see that point 1, point 2, point 3 here, and the market continued in the same overall directional movement of the market. So trend line and Fibonacci can be added as a confluence for us to get a next wave of movement, at the same time using this psychological level of 1.250 as the next wave of entry point to jump into this market, because we saw certain candlestick formation within this range that gave us indication that this market isn't going to continue its bullish trend all the way up, and then there's possibly reversal in this range for us to have a new trade of movement all the way down. So clearly, guys, you can see that all through from this top all the way to this bottom, I've given you clear indications of how, as snipers, I would be thinking into the market to find trades and then to find turning points in the market where I'll be catching swing points with huge pip profits, not just catching 10 pips, 20 pips, 15 pips on the market, but catching 100 pip movement, a 200 pip, a 250 pips, and so on, with a very small risk of 30 pips, 40 pips, and then maximum 50 pips in the market, right? So currently, as I'm speaking with you guys, if you're watching this chart, you can clearly see again that the pound versus the dollar is rejecting around this area, which is a psychological level for me, which is 1.2750. So all I have to do now is patiently wait and see how candlestick formation react around this range. If it gives us a clear indication that this market is holding off here as a strong resistance, because it previously did here to hold here as a strong resistance, then we can jump in for a sell position, putting our stop loss right above the range. So this now explains my concept of why I use no indicator to trade, but just candlestick formation and pure price action reading into the market, the tip reading that gives me a very good risk to reward ratio and then a minimum stop loss level in the market. You can clearly understand that if I should put on any sort of a moving average on this, it would give me a very late entry into the market, because I would be depending on the moving average to cross this market candles before I get any confirmation or any form of a strong bias to jump in for a sell at this point in time, right? So as time goes on, I'm going to be revealing to you a little bit of tricks and how I spot clearly all these entry points. But this one, this second video has clearly given you guys the clear concept and then the whole basis of what I look into. Next time I'm going to delve strictly into market structure, so that I explain to you what rule the market really also based on, because anything at all, or the market as a business at all, has its own rule and then its own basis of movement. And when you come to understand the market structure, the rule in which the market follows to move, it gives you the basis of understanding the language of the market, and then it also gives you a basis of determining who is in control of the market at any point in time. You guys must be aware that the market is made of what the bulls or people that are expecting or in anticipation that price should go up, and then the bears, which consists of people who are anticipating or projecting that price should come down. I believe this information alone is a lot enough to help you to spot entries on the market, not just with support and resistance levels, but understanding that there are psychological levels and then areas into the market that if you delve into, it is nothing online and then you've not seen anything like that, but it will give you a clear cut entry with very minimum stop, and then you would be consistently making money and jumping onto the market at the right time of a turning point of a swing move. I hope to share more details with you. At the same time, if you're here, don't forget to click on the link in the description to join the Telegram channel, because from time to time I'll be sharing my trade setups and then free signals, and you can learn as we grow as a family how I spot these kind of crazy entry points in the market to be making huge pip gains in the market. On this video, I may end up sharing some screenshots of some of the trades I've taken on the pound versus the dollar, so you understand the turning point in which I got into the market. I believe this one educates you guys a lot, and I hope to see you guys in my next video, where I'll be showing you a continuous progression of the development of this strategy, guys. Yeah, so I hope you guys enjoyed this video and then you learned a lot. Like I promised you, exciting content coming up. This is just a snippet, right? There are so many things I'm going to be showing you guys, which is nowhere on the internet, like I promised. This is just a little bit of insight into what I'm going to be putting out on my YouTube channel. Click on the subscribe button and then click on the notification bell to get notified anytime I post a new YouTube video, a new content. Also, don't forget to follow me on all social media at Kojo Forex, all on Instagram, Twitter, and Facebook, right? Don't forget to also click on the link in the description to join the Kojo Forex Telegram channel, which is the Kojo Forex community, where I post out 1 to 3 trade signals for free every week for anybody who is part of the community. Peace out.